Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
Navigating market volatility can be challenging for individuals nearing retirement. Here are key strategies to help manage risk and protect your retirement savings in these tumultuous times.
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you have individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome in to How to Retire with Ben Fuchs.
Welcome on into the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. Here to help you take charge of your money this week is Gina Mazzadra. Gina is in for Ben again.
Hi, Gary.
And hi, how are you?
Good, how are you?
Boy, what's good to be the boss, huh?
Yeah. 3 weeks in a row.
Okay, so we started out in Napa Valley. He moved to Fort Myers, which he got out of there before the floods and the rain and all that, I guess.
Yep.
And now, where is he now?
Now he's in Narragansett, so
nice.
On vacation with his family. Yeah.
All right. Well, he must trust you a lot, Gina, which is really it's a good thing, I guess.
Apparently, yeah, and he gets to go enjoy his time on vacation, and guess it works.
Yeah, and you handle the whole thing.
And now I'm in charge. Yeah.
Gina's in charge, ladies and gentlemen. It's good to be in charge. All right, so yeah. And Gina, by the way, is not new to this. She has over 10 years experience in the retirement planning business in the last 3 years with Fuchs Financial. Where'd you go to college again? I know you told me, and I can't remember.
Yep. So I went to Southern Connecticut State University for my undergrad, and then I went to University of Hartford for my MBA, concentrating in finance.
Right, and you have all these series licenses, right?
Yep, 766 RICP, accredited retirement planning specialist. Yep.
A lot of them.
Yep.
So there you go. Can't keep track of all those degrees and certificates that Gina has. All right, so good to have you here, Gina. We're going to get into the show right now. Navigating market volatility can be challenging for individuals nearing retirement. There are some key strategies to help you manage risk and protect your retirement savings in these tumultuous times. And we'll go through these one by one. We'll take our time with it because, we can. All right, I'll start with the first one. Diversify your investments.
Right. So what we want to do is diversify across the asset classes, so stocks, bonds, real estate, et cetera. Not just, diversifying in between stocks themselves, but having different buckets that you're putting into. So, for example, you have like growth, income, and safety. In those different buckets, then you might use different stocks, mutual funds, ETFs, bonds, alternatives to bonds, annuities. I met with one person back a while ago who had everything that they saved in Tesla stock. And they did not want to get rid of it. They wanted to hold on to it. And, we explained to them that a lot can happen. Obviously, since he bought it, it had gone way up and he wanted to hang on to it. Fine. But that's, not someone we can really work with as a client, because if they don't want to take our advice and diversify what they have, there's not a lot we can do to help them. But we want to kind of avoid that, and that's not everybody. Most people don't just hold one individual stock with all their savings.
Right.
But people who do that, we want to try to see what we can do to break it up a little bit.
Yeah, no question about it. What about international exposure?
That's a way to further diversify your portfolio. So, aside from the buckets that we just talked about, the stocks, bonds, real estate, holding some international pieces, a lot of times that can be included in like mutual funds and ETFs. You can hold that too. Yep. But it can just kind of give you a little more variety for what you're holding in your accounts.
Mm-hmm. Let's talk about the second one, adjust asset allocations. Let's talk about that. Shifting to conservative investments. I guess the older you get, the more conservative you get, but you don't want to be too conservative, right, Gina?
Right. So gradually they increase the proportion of low-risk investments like bonds, fixed income securities as you approach retirement. And they rebalance your portfolio periodically to maintain your desired asset allocation. So basically what these are target date funds. So when you have your 401k plan or 403b, whatever it is, a lot of times what you're offered as an investment option is a target date retirement plan, and that might be something ending in like 2035 or 2025, right, depending on the year that you plan to retire. That year is based on your retirement year. So what those do is they become more and more conservative as you get closer to that target date year. These are good, but they're based on rule of thumb for the most part. So they go down by like a certain percentage in terms of risk. They're not appropriate for everybody because when we're planning for our clients, we're actually planning based around their individual circumstances, not using a rule of thumb per se, if that makes sense.
Right. So those target date funds, they automatically will adjust as time goes by, as you get closer to the timing out, or for whatever, lack of a better term.
They adjust based on timing and how close you get to retirement. They don't adjust, obviously, based on your individual circumstances.
Right, of course.
So that's where an advisor can come in handy, because we, plan around your individual circumstances and not just a time frame.
All right, let's keep going. Keep a cash reserve. It's always good to have that emergency fund, Gina.
Right, yeah. So we want to maintain a cash reserve of, 6 to 12 months of living expenses. That gives a buffer if there's a downturn in the market, and having the cash on hand to take advantage of when the prices are low in the market. I think to just have at least 3 months of cash on hand for what your expenses are at all times, and then 6 to 12 if you have a little bit more income to take advantage of those upturns and downturns. But I had somebody come in the other day. They have all of their savings in their IRA and Roth IRA, which is great. But the problem is, if they had an emergency, they then have to take the funds from the IRA and use that as income instead of just having a little bit of cash on hand. It's taking it from an IRA can take some time to withdraw it out. You have to sell the positions in the account, and then you have to wait for the ACH to go from your IRA to your bank. Can take about a week or so total. Yeah. So just having the cash on hand, if your furnace blows or you need a new car part, you want to have that available to you.
Right. They're not very liquid. That's absolutely sure. Okay. How about this? Consider income-producing investments like dividends and interest, I guess, huh?
Yeah. So investing in dividend-paying stocks and bonds to create a steady stream of income, exploring annuities for income. The annuities would be more of a guaranteed income. But you want to be mindful of the terms and the fees of the annuities. But basically, one thing we actually do here is we have alternatives that we use, alternatives to bonds that we use for investments to generate a supplemental paycheck for our clients. And this is what a lot of our clients are looking for when they're getting in or near retirement, because they're no longer getting the paycheck from work. So we want to be able to send out something to their bank account on a monthly basis that's going to be used for their living expenses. Sure.
Delaying Social Security benefits. Increase your benefits. Let's wait as long as you can. That makes sense to me.
Right. So sometimes it makes sense to wait. Sometimes it doesn't. By delaying until 70, you're going to get the highest payment amount per month from Social Security. So your full retirement age, generally, if you're born 1960 or later, your full retirement age is 67. If it's before 1960 that you were born, it's like 66 in some months. So 70 is the latest that you can take it, or 62 is the earliest. If you take it between 62 and your full retirement age, it goes up 6% per year. Taking it from full retirement age onto 70, it goes up about 8% per year.
Right.
a reason you might want to wait is if you're a rather conservative investor and you don't actually need that income, then it probably makes sense to wait because you're getting a higher rate of return by just waiting than you would if you had it in some, conservative low rate of return investment. On the other hand, some people just need to take it sooner. So if your expenses are exceeding your income, then you need to have some sort of other income that you can use to live off of so that you're not drawing down on principal.
Yeah, everybody is different. Everybody has a different situation. It's funny. Most people think that they reach full retirement age, they max out their benefits, but that's not true. If you wait to 70, I believe it's like 132% of your benefits, Gina. So it's worth waiting if you can. But again, everybody's individual. Everybody's needs are different. Let's talk with this one. The next one. Work with a financial advisor. Makes total sense to me. Work with Gina and Ben, for sure. Yes.
So, a financial advisor can provide tailored advice based on your specific situation and risk tolerance. So, this is... We don't use, like we said earlier, rule of thumb. We look at your specific individual situation to determine how your accounts should be allocated. Instead of saying, we should have, 60-40 and, growth and safety. We don't look at it that way. And then we want to schedule regular reviews to adjust the strategy as needed, because obviously in retirement your situation can change at any time. We want to make sure that we're on top of those changes so that we're working around your lifestyle. All
right, a couple of minutes left, Gina. I love this one. Stay informed and calm. Market education, right?
Yeah. Actually, this past week so basically what we want to do is we don't want to react to what's happening in the market. We don't want to panic sell. I had a client who I spoke with at least 3 times this past week because of this past Monday or about a week ago when the market had a significant drop.
Yes, it did.
Yeah, so she called me and she said, her friend told her to sell everything that she had because the market's dropping and she needs to get out of it now. And and so I, talked her down. I said, no, we plan this because we know that these things are going to happen. We can't predict the future, but the way that we have the accounts set up are to cushion when these things happen, and we expect them to happen in the future as well. This isn't going to be the last time that there's a market correction, but the way that we plan it is so that if it does happen, you're not impacted as much as you would have been if you were just, working on your own.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well, and it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
If you're retirement planning, we're a baseball team. The position players could be metaphorically representing as follows. So we're going to go through each position on the field. Now, Gina and I were talking before the show, and I'm happy to report that Gina is a Yankee fan, like me. Right, Gina?
Yep. Yeah, we're a Yankee family.
All right. And it's funny, Hartford is kind of that dividing line. A little bit to the north is Red Sox territory, but further south becomes more like Yankee territory. So we're happy about that. Okay, so we're going to go through each position. I'm going to name the Yankee of that position, too. Okay, so let's talk about catcher, financial advisor. That'd be Austin Wells for the Yankees. Let's talk about the catcher a little bit.
Yeah, so the catcher is like a financial advisor who plays a crucial role in managing the game, the retirement planning from behind the scenes. So providing guidance and support.
Yeah, absolutely. We need some sound effects here.
Oh, yeah.
So here's a little crowd noise. We got that going on, and we got this, too.
Play ball!
We like that one.
I like that one, too. All right, so that's the catcher. The next position would be pitcher, and I can think of Cy Young Award-winning Garrett Cole for the New York Yankees. What does the pitcher represent?
So the pitcher represents retirement savings itself, delivering the financial resources needed to sustain the game. So the game being retirement over long term.
All right, that's what the pitcher does. First baseman would be DJ LeMahieu for the Yankees or Ben Rice, and it's about Social Security benefits, right?
Yeah, you're pretty good at remembering all their names. Social Security benefit acts as the first baseman, providing the foundational support to retirement income. It's not going to always be sufficient on its own, but it's a leg of income.
Mm-hmm. And Social Security was never meant to be a complete part of your financial plan, Gina.
Correct.
What do you think? Around 40%, sometimes 60%? It depends on what folks have. All right? Am I right?
It really depends on what your expenses are. So if your expenses are meeting what the Social Security income is, then that's all you might need. But if they're higher, which for the most part, for people I see, they generally are, then you need another leg of income to rely on.
Yeah, but basically if you have a rent or a mortgage, because it's generally, maybe it'll just cover that, but it's not going to cover your daily living expenses unless you're...
Right. Unless your expenses are super low. You probably also need to rely on pension income, or if you have, a part-time job in retirement, or an annuity providing income, or, just drawing down on your investments in your retirement savings, different options.
Second baseman, Gleyber Torres for the New York Yankees. Employer-sponsored retirement plans, Gina.
Yep. So the employer-sponsored retirement plans, like those are 401ks, 403bs, they play a role of the second baseman, contributing to the overall strategy with significant financial benefits. So one of the biggest benefits of an employer plan is that you get a match. Most people do. The match is as close to free money as you can get. So you definitely want to make sure you're taking advantage of that, putting the funds away into your retirement savings for your future self, and then getting the match that's going to add to it and bump up what you have already.
Mm-hmm. And most plans have changed to employer contribution plans now, and pretty much done away with pensions, except for maybe state and federal employees, Gina. Am I right, pretty much?
Right. A lot of people, growing up, they probably thought they were going to retire on pensions alone in retirement, and that's not so much the case anymore. People need to save for themselves and put that money away over the years, and then that's going to be their retirement savings.
Mm-hmm. All right, shortstop, Anthony Volpe. He was a rookie last year in his second year in the Yankees. Personal investments. Let's talk about that a little bit.
Right. So personal investments, stocks, bonds, mutual funds, etc., can be seen as the shortstop. So agile, versatile, providing additional avenues for building wealth.
Mm-hmm. What do you think? And this gets into our 60-40 rule, so to speak, that you have 60% of stocks and 40% of bonds. But that necessarily doesn't hold up these days. That's one of those rules of thumb, again, that not everybody adheres to. Am I right, Gina?
Right. We don't generally go by rule of thumb. We go by what's your individual circumstance. That's why people are hiring us. They're not hiring us to say what the rule of thumb is. Anybody can figure that out online. But what we're doing is we're creating a specific strategy based on your lifestyle. So again, we look at, what do we have saved, what are we earning, and what are we spending?
Right. And different asset classes too. So you make sure you can diversify. Am I right?
Mm-hmm. Yeah. So like we said before, different types of investments, different buckets we want to put into. There's growth, income, safety, and we want to make sure that we're dividing it among those three buckets according to what you need.
Let's get to, we got through shortstop. Third baseman. The Yankees recently acquired a third baseman in a free agent from it was a trade from the Miami Marlins. Jazz Chisholm, Gina. Remember that name? Jazz, all right?
Okay.
Yeah. Real estate investments. That's third baseman. What do you think?
Yeah, so real estate investment guards the third base, offering tangible asset class that can generate income and appreciate over time. So as opposed, I know today it's tough if you were to go out and try to buy a house right now, but it's a better alternative we see than renting, because you have equity in it. If you were able to generate additional income on it as a rental, then that's great, and that's something that you can do well into retirement without having to get that is the second job, but without having to actually go to work for that second job.
Yeah, but it's not for everybody unless you can, unless you're prepared to get a call at 3 a.m. to fix the plumbing, Gina. Am I right?
Right. Yeah.
Unless you can have a management company, I guess, right? A lot of people do that.
So a lot of people hire management companies, but we do have some clients who have just one rental, and what it does is it covers the expenses of that home, and then it covers some of the other expenses of where they're currently living. So it might even cover the mortgage or the taxes to cover the house that they're currently living in. And if that's the case, then it's worth it to have that. And again, property values going up over time. We expect them to. It's a good alternative asset to have in your portfolio.
All right. Left field pensions. Alex Verdugo, former Boston Red Sox, now a New York Yankee. Let's talk about pensions. They're not around as much, but still around, right?
Right. So pensions, although they're less common today, cover left field, historically playing a critical role in retirement history for many. So I know the older generations, they would have pensions to rely on in retirement instead of the 401k plans. Those were our parents' age that, when they retired, they were relying on pensions. Pensions have been replaced in retirement by the 401ks and 403bs. So we're not really relying on this additional source of income. We're relying on our savings ourselves that we're putting away, and then we're generating income on what we have saved instead.
All right, now we move to center fielder, superstar, former MVP, Aaron Judge. I'm sure you've heard of him, Gina.
Oh,
right?
Yeah. We all know about him.
we do, yeah. Leading the league right now at this recording of over 42 home runs.
Wow.
And over 106 RBIs. He's like killing it. Yeah, so anyway, emergency savings, Gina. Let's talk about that.
Yeah, so emergency savings, they want to cover the expansive center field, ensuring that there's a safety net for unexpected financial challenges during retirement. So like we talked about before, around 6 months worth of expenses in a savings account in case of emergency to fall back on, because should something happen and we need to pull the money out of the IRA, it may not be there quick enough for those emergency situations.
All right, couple of minutes left. The right fielder, new to the Yankees this year. He's on a one-year deal. Lots of folks think they can help keep him there. Is Juan Soto, just another superstar. Mm-hmm. He's a right fielder. Healthcare savings, Gina.
Yeah, so healthcare savings guard the right field, addressing increasing need for healthcare expenses in retirement.
All right, designated hitter. We could talk about annuities a lot. Designated hitter would be Stanton for the Yankees. How about annuities?
Right, so annuities can act as the designated hitter, providing guaranteed income streams to complement other retirement assets. So there's ways to put money into an annuity and then down the road start to take that money out as monthly payments for income. Now, this is a guaranteed safe piece as opposed to drawing down on principal from an IRA where it's trying to grow the income.
Utility player, Oswald Cabrera for the Yankees. Individual retirement plans, IRAs, Gina.
Right, so IRAs can play multiple roles like a utility player, offering tax advantages and flexibility in retirement planning. So basically what can happen with these is we can have a lot of growth within those accounts, and then we're not actually paying taxes on it until we actually withdraw it. And one goal that we have with a lot of our clients is to withdraw it as a source of income. So we want those accounts to grow, generate cash that accumulates within the account, and then send that cash out to their bank and then use that as an additional source of income. And again, you don't pay taxes until you actually withdraw it.
We believe in better. A better way to invest, a better way to serve you, and a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
All right. When planning for retirement, there's several important pieces that people often overlook or forget to include. Now, these have significant implications for their financial security and overall retirement experience. Now, we're covering 7 commonly overlooked components of retirement plan and why they're integral to your plan. Oh, we're going to say the I word, Gina. We haven't said it all show. We haven't said inflation yet, so there you go. Let's start with inflation.
Yep. So failing to account for inflation can erode your purchasing power of retirement savings over time. So what you can do is it's crucial to include inflation adjustments when calculating retirement income needs and investment returns. So I had somebody who came in the office the other day. They came in for their second appointment and they said, I think I should be fine for throughout retirement based on what my expenses are. And I'm saying, well, okay, but based on just straight drawdown of your accounts, maybe you would be fine. But if we're not looking at inflation, the historic 110-year average of inflation is like 3.27%. So we want to include that going forward with all the expenses. I know the actually the 10-year historic average is only 2.8 something percent. The 10-year historic average is actually a little bit lower than the 110-year, but we use the higher of the two just to err on the side of caution. But when I showed her that, hey, if we actually include inflation, you are running out of money a lot sooner than you anticipated to, closer to 75, which, in your 70s, you don't want to be running out that early because you still probably will be, doing well and happy and wanting to live your life in your 70s. Maybe in your 80s and 90s, you might be living a different lifestyle, but in your 70s, you're still up and doing stuff, and you want to be able to keep going.
Yeah, we call it the go-go years, and there's the go slow years, and there's the no-go years when you get a little bit older. But yeah, it's particularly the early part of retirement. That's when people are most active in spending the most of their retirement money. Am I right, Gina?
Right, and that's what we want clients to do. We want you to go out and enjoy your retirement. That's what you worked so hard to do. We don't want you to be stuck, not able to enjoy life. We want you to be able to do it, and we need to prepare for inflation. If we're going to prepare for that. Yeah.
Ramen noodles is fun when you're in college, but not so much when you're retired, Gina.
No, we don't want to be stressed about it.
No, it is 52 cents a packet at Walmart, by the way. I just want to let you know in case you need.
Oh yeah, perfect.
Okay. My grandkids love that, so we do buy a bunch of that. Nothing's wrong with ramen. All right.
No.
Market volatility, Gina. The old market volatility situation, huh?
Yeah, so retirees sometimes forget to reassess their investment strategies in light of their reduced income needs and risk tolerance. So basically, people come to us and they have these IRAs that have not changed in decades since they started investing in them. And our goal is to look at it and say, all right, well, we're taking way too much risk. Or, maybe we could be a little more growth oriented. But basically, as time goes on and you get closer to retirement, we want to make sure that we're having everything allocated appropriate to your age and how close you are to being done working.
Right. And I believe the historical average market returns over the last 100 years or so is somewhere around 10%. So, market goes up and market goes down. But like you said earlier, you don't want to sell everything when that market is down. Right, Gina?
Right. So if the market were to go down right before you retire, that's a significant impact on how your retirement could play out. So just the timing of it. So what we want to do is we want to avoid that happening, and we want to reallocate before we have a market crash. We don't want to react to the market going down, but we want to plan for it to go down at some point.
Right. And when market's down, there's a phrase that people would say, stocks are on sale. So that's the time to buy probably, right?
Yeah. So, that could be a good time to buy. But in general, if we're looking at retirement savings, we want to make sure that we're not trying to time the market. We're not trying to react to what the market's doing. We want to prepare for it to have its ups and downs and be somewhat conservative in a near retirement.
Yeah, someone once said, it's time in the market, not timing the market, because even Warren Buffett says timing the market can be very difficult, and if anyone should know or try to do it, it would be him. All right, inflation, market volatility, retirement income, Gina.
Right. So some people forget to plan for additional income sources in retirement. So additional income sources being part-time work, rental properties, the investments that we have in those IRAs that we can send out. So what we can do is diversify the income streams to provide greater financial security. So basically what we're saying is having different streams of income is beneficial. So if we have the Social Security mixed with some pension, some annuity income, and then the rest is market-based income from a structured note that we have generating income. So having all of those different sources, so that if some of the pieces that are not guaranteed are not producing the income, we have the pieces that are guaranteed to still produce the income.
Right. Here's the next one. This is a big one, too, healthcare costs. Particularly, let's say you retire, I don't know, at 62 or 63, and Medicare's not going to kick in to 65. That's when it becomes a big concern, because you got to fund your own health plan at that point, Gina.
Right. So many retirees underestimate the expense associated with healthcare, including the premiums, deductibles, copays, potentially long-term care costs. So it's essential to budget for those healthcare expenses, which can oftentimes be pretty significant.
I heard a stat once that for a couple, you may need over $300,000 in health care costs. Have you heard that amount too?
I have heard that before, and obviously it's going to depend on the person needing, depending on what their needs are, their health. But yes, I have actually heard that before.
Yeah, it can be very, very costly, and it's something that Gina will bake into your plan when you meet with Gina and the team at Fuchs Financial. Absolutely. The How to Retire Blueprint, 800-380-8985. The show is How to Retire with Ben Fuchs. Gina filling in once again for Ben, who promises to be back next week. We'll see about that.
Yeah.
We'll take it 1 week at a time. All right. Let's talk to something that's really overlooked from time to time. And people think you need to be, have millions and millions to have a estate plan, but everybody should have an estate plan, Gina.
Yeah, so like for taxes, retirement income from different sources like pensions, 401k, Social Security, the different sources of income can affect how you're taxed. So if your only source of income were from Social Security, you wouldn't pay taxes on it at all. But sometimes what happens is when we have Social Security mixed with pension and IRA withdrawals, it causes the Social Security to become taxable. So one thing that we look at when we're planning is the tax aspect of everything. And we say, all right, well, this is how much income we have that we can stay under this next bracket for your taxes. So if we can control that in some way, which a lot of times we can before we're of RMD age, we do that. Now, after we're RMD age, 73, sometimes we have less control over it, but we can plan for it in advance before we get to that.
Yeah, you answered my question just to ask about RMDs, and you answered my question. So terrific. Yeah. All right, a couple of minutes left. Longevity and risk management, Gina.
Yeah, so people are living longer, which means retirement savings needs to last longer too. I actually had someone come in maybe a year ago, and she told me she was going to live to be 120 years old. So we made a plan for her living to 120. So yeah, I mean, that's great. That's great. So we made a plan for her, and we said, all right, well, sure, if this is going to happen, then we need to keep the expenses to this. We need to have this grow a little bit more over time. We need to delay taking Social Security so we can get that higher amount. And I think Ben probably remembers this too, because we had a conversation about this. Yeah.
Well, good for her. Well, let's hope it works out, boys. She'll be one of the oldest person alive on the planet.
I mean, I'm excited. We'll see. That'd be pretty exciting.
Yeah, it would be, absolutely. Imagine blowing out the candles on that cake.
Yeah.
Have to call a fire department, that's for sure. Am I right? Yeah.
We'll need a big cake for that.
You're going to need a very big cake. Okay. Last one. Continue monitoring and making adjustments, because your plans, they're not static. They're always flexible, and they're moving, they're changing. Am I right, Gina?
Right. So it's common for a lot of people to overlook their budgeting and unexpected expenses in retirement. One thing we have people do is we say, all right, well, we want to know what your expenses are for the last year and how much have you spent. And then people come back in and say, well, I had this odd end thing that happened, and I had this odd end thing that happened, and I don't really want to include that. That's not my typical expense. And we say, well, it kind of is, because, there's always going to be unexpected things happening in your life. It's just something different every year. It's always going to be something different, but they're going to happen. And so we do want to include those things for the most part in terms of retirement planning and knowing how much we need for income.
All right, there you go. 7 aspects and components of retirement that are often overlooked. Great job with that, Gina.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
Let's see. I started taking my required minimum distributions this year, RMDs. I have 3 different IRAs. Should I take some money from each account or take it all from one? I know you can do either or either. What do you have for George, though? We don't have a lot of information. We don't know. Well, obviously, he's old enough to get his RMDs, Gina. That's one thing we do know. Yeah.
Right. So you're old enough. You're taking the RMDs. Basically, what we want to look at is how the accounts are allocated. So do we have some of the accounts that are more growth-oriented or income-oriented? But basically, with the RMDs, you have to take out a certain dollar amount based on the IRA value as of the prior year end. So that dollar amount is going to stay the same. You can take it from one of the accounts and it will account for all three. And you just total the year-end value for each of the accounts, and then you can take it all from one, or you can take it across the board a little bit from each. What I usually look at is, again, how it's invested. So if we can avoid, maybe selling something and taking a loss, we might do that. We can really take it from any of the accounts or from one. Again, it depends on how the accounts are allocated. Sometimes we have cash sitting in each of the accounts, and if you have the cash that's already available to you and it's enough for the RMD amount, we might just have you send it all from the accumulated cash across the three.
Right. And you can mitigate that if you do charitable deductions. A lot of people do that too, Gina, right?
Yeah. So if you send it to a charity, a qualified charitable deduction, you can avoid paying taxes on it altogether. So it would have to be sent directly to that charity, but that's definitely something that people do to control their taxes if the income from the RMD is higher than the income that they need to live on.
Right. And the key to that is never touching the money. The money never touches your account. This way, it's not a taxable event. So it needs to go directly to the charity, Gina, correct?
Yeah, so it's a qualified charitable distribution. It goes directly from the IRA to the charity. You don't pay taxes on it. And, if you're charitably inclined, then it makes sense to do, wait until you do your RMDs to have it sent directly to that charity.
All right, Lauren in Litchfield, I'm no longer employed. Can I roll over a 403B plan into an IRA or into a Roth conversion? So 403B is people who were maybe teachers or federal or state employees, Gina, is that pretty much right?
Yes. Yep. That's pretty much the people that pay into the 403Bs. If you work at a hospital, if you're a teacher, yep, exactly. So
how do you do?
It's a good idea to take the money out of the 403B, 401k accounts and put them in an IRA. One reason being that you could easily forget about it being there, and then when you're out of work for a few years, you might forget what your login information is. It just makes it harder to access. So definitely putting it into an IRA away from where you worked. And then once it's in an IRA, you can then do a Roth conversion. The Roth conversions can be in any amount, but what we want to pay attention to is the taxes, because when you're doing the conversion, you are paying taxes on it. So we want to only convert enough that it's not bumping you up into the next tax bracket.
So if you're taking your 403B and rolling into an IRA and not a Roth, is that a taxable event, Gina?
No, so it's a non-taxable event. So a rollover is non-taxable. It goes from pre-tax to pre-tax, unless the money that you put into the 403B is in the Roth option. Right. And then in that case, you would convert it from Roth 403B, Roth 401k into a traditional Roth IRA. Right. That's the only... And you wouldn't pay taxes on doing the rollover anyway. So no matter what, when you're rolling over from an employer account to an individual account, it is not a taxable event. Right. Okay. Good news. Good news. People need to know that. All right. Robert, West Hartford, what's the difference between an index fund and an ETF, exchange traded fund, Gina? So the biggest difference that there is like an index fund, like a mutual fund. They're traded at the end of the close each day. So where an ETF is real-time dollars. So the ETF is going to fluctuate with the market values throughout the whole day, just like a stock does. You're going to see that number changing constantly. The mutual funds are only as of close. So if you're looking at your account and you're saying, oh, there's no day trade value here, most likely because it's in mutual funds. A lot of 401ks, 403bs are mutual funds that they allow for investments in there, as opposed to ETFs. Another difference is the way that they're taxed. So the taxation of mutual funds, sometimes you end up paying a little bit higher taxes on as opposed to the ETFs because of the way that they're calculated on their back ends. And another difference is the fees. So generally, there's a higher expense ratio on mutual funds than there is on ETFs. Mm-hmm. The mutual funds is the fee that the money manager behind the scenes is charging to manage that fund actively. That's higher on a mutual fund than it is on an ETF. All right. Final question. Albert Glastonbury. And I've been doing these shows for a couple of years now. I'm not familiar with this. What is
quote, in quotes, period, certain mean on an annuity contract? Complex language part of the contract is tough to understand. A look at payout options looks like there's a cutoff age. I don't have a current advisor with my annuity company. Well, maybe you need to get an advisor, Albert. What do you think, Gina? I'm not familiar with this.
Right. So period certain basically means that you're going to get that payout for that certain period, for that certain number of years that's predetermined in the contract. I actually have someone who specifically wanted a period certain annuity recently. They wanted a 10-year period certain annuity, and basically what that is you put the premium in, and for 10 years, you're getting this same monthly payout option for 10 years. It ends at 10 years. So if the annuitant were to pass away, the payments still continue to go on to a beneficiary that he's designated for that 10-year period. So it doesn't pass away just because the annuitant has passed away.
All right. George, Lauren, Robert, Albert, thank you so much for your questions. That's all we have time for today. Gina, final thoughts as we wrap up today's show. What do you have for me?
Sure. So we've spent a good deal of time talking about retirement today, and we want the folks to know that we keep a few openings on our calendar for a free review for anyone who has more questions about this. So give us a call and we'll chat with you personally, and we'll try to answer any questions you have. From there, we'll go through all the different puzzle pieces that we need in order to put your plan in place. We'll look at things such as Social Security, risk, taxes, inflation, legacy planning, and Gary can tell the folks how to get a free review.
Absolutely, Gina. The How to Retire Blueprint starts by picking up the phone, 800-380-8985, 800-380-8985. Folks, advice like this shows you how important it is to meet with a financial coach. Meet with Gina, Ben, and the team. They understand the ins and outs of the financial world. We want you to take advantage of this opportunity to make sure you're on the right path. The path is based on your risk preference, your budget, and your goals. The How to Retire Blueprint, 800-380-8985, vital part of your retirement planning. You deserve a more confident plan to retire. You want to be stress-free, peace of mind, but like I said earlier, nothing changes till you pick up the phone. Gina and Ben cannot help you unless you do that. 800-380-8985. Well, we're up against the clock. The show has flown right on by. I'd like to thank everyone for listening. We hope you found the information we presented helpful. Look forward to all of you being back next week. We'll have new topics and new questions right here on How to Retire. And maybe, Gina, maybe Ben will be back, right?
Yep. We'll see what next week brings.
All right, Gina, thank you so much. I enjoyed working with you. And have a good week, and we'll talk to you soon.
Thank you. You too.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.